The ETF industry has been disrupting the way people access markets for 30 years. ETF issuers, the product providers, are on the front line of that innovation. Here, we get to learn what it takes to be a disruptor. This is Wavemakers. Welcome to Wavemakers. I am Cinthia Murphy, Head of Research for the ETF think tank. And today I am joined by Alejandro Garza, who is founder and CIO of AZTLAN Equity Management. Welcome, Alejandro.
Cinthia, thank you so much. Pleasure to be here. Thank you.
Well, I'm excited today. We have a Brazilian speaking to a Mexican in the United States. It's a fun coming together of the world. So it's an exciting conversation. I thought we could start, Alejandro, by you telling us a little bit about the history of AZTLAN. You have, you're a chemical engineer, MBA by trade. You come from the investment banking world. And then in 2016, you started AZTLAN, which is an investment advisor. So tell us a little bit about that journey and why start AZTLAN.
Great, thanks, Cinthia. So let me start with the AZTLAN story. And then, I'll share with you a little bit about my personal story. So AZTLAN Equity Management is a registered investment advisor. We've been in business for 7 years now. I started the firm late 2016. And so we've been in business for these 7 years. Our focus was originally to manage small and mid-cap strategies. We started with an emerging markets small and mid-cap strategy. And then after the first year, we launched our second strategy, which is developed markets small and mid-cap. So it was like a 180-degree change from emerging to developed. And since then, the developed markets small and mid-cap strategy has become the most important, largest strategy that we manage. And then over the years, last 4 years, the developed markets strategy has branched out into several versions of that same strategy. And so with that, what we now do at AZTLAN Equity Management is we manage both strategies and funds to carry out those strategies. And we also advise institutional investors, family offices, and high net worth individuals. So it's both managing funds as well as separately managed accounts. So that's the background for AZTLAN Equity Management. Is we're an investment advisor, 7 years in business, and I think just then going back to a little bit of my story, I started AZTLAN 2016 after I had spent 10 years with a large investment management firm, originally called Emerging Markets Management. This was a pioneering investment manager in emerging markets. Actually, they coined the term emerging markets back in the 80s. Quite interesting group. We were a large multinational firm. All emerging markets nationalities were represented there in the investment committee. Managed money for pension funds, endowments, family offices, etc. A large institution. And then I started that in 2006, I think. And then 2011. The Ashmore Group came in and acquired the company, and so we became part of the Ashmore Group. And so I stayed with the Ashmore Group, managing the on the equities side, starting 2011 and up until 2016. Before that, I had experience in corporate finance and, as you mentioned, in investment banking. So I have this broad experience within the financial sector. On the advisory side, on the buy side, on the sell side. And at that point in 2016, I really, had this strong view that investments could be done and should be done in an optimal way that was kind of different from what we were doing. These were all great institutions. I owe all the things that I've learned to these institutions and to the people that I worked with and I worked for. But I really thought that there were a couple of things that, in general, the way I see it, are oftentimes missed out in the investment process. And so that's, that strong view is what led me to leave Ashmore at that point and start AZTLAN Equity Management.
So how difficult is that leap, actually, like to leave something you're comfortable with, it's a thriving business, and just go start from scratch and create a completely new business? Was it like a year of starvation and suffering and doubt, or was it like hit the ground running and total confidence in what you were doing? I'm just curious about, actually jumping and going.
No, absolutely. I mean, it's a mix of things. I think first of all, you have to have an inner voice that is rebellious and pushing you to do crazy things. I was 40 something at that time, so I wasn't getting any younger. Something that I always wanted to do, but at that point, I thought and I felt like I had the experience and I've had some good things to bring to the table as an entrepreneur. And it's really that rebellious voice pushing me from the inside to do this crazy thing, because the Ashmore Group is a great institution. I think I had the great opportunity to work with amazing people there, amazing professionals. But it was that inner voice that said, no, this, there's a better way that, you can actually do this and implement this. And also ignorance. I was completely ignorant as to, all the challenges that it would entail. It's super challenging, very difficult, even when you have a good track record and come from one of the large, investment management houses, and you have all this experience. Super difficult to start a new firm, to build a team, to really crystallize what your vision is in terms of the investment strategy, and then putting it all together to convince investors to give you to trust you with their assets for you to invest. So it's really you have to be a little bit crazy to make that leap.
So rebelliousness, inner drive, and ignorance is the secret here. Yes. Got it.
Yes, that's the secret. Yeah, right combination.
So let's talk a little bit about the focus of the firm: small, mid-cap, global equities. Is the idea to focus on this space given your experience before starting AZTLAN? Is it because, at least we hear when we talk to advisors, that a lot of investors tend to be underweight, underallocated to small mid-caps, especially mid-caps? Was this an effort to differentiate yourself in the investment management world? Why did you choose this focus specifically?
So, yeah, definitely. I mean, it's a segment within the investable universe that's generally underrepresented. Most investors have excess exposure to the mega caps nowadays, to the American market, to their own domestic or local markets, real estate, real assets. Those are kind of like the big overexposures in general, just generally speaking. And the small and mid cap space is underrepresented, but also it's a combination. When I was with Ashmore, I had the opportunity to co-manage a Latin America small cap fund. It was a really small fund, but what I found there was there were all this very interesting companies in Brazil, in Mexico, Chile, and Colombia that are again under the radar, underrepresented, underexplored. And that in turn provides for an interesting investment opportunity because of that same fact. These names tend to trade at a discount because they're under-owned, and so valuation multiples tend to reflect that. So it's a combination of attractiveness, experience, specific experience in the space, and also within that idea that this could help us differentiate ourselves. It's also the fact that I think that our investment process, which is a combination of quant plus fundamental, really, this space, small mid cap, if you apply quant, let's say screening, and then in-depth fundamental research and analysis, you can really, find all these wonderful companies globally, and global markets, international markets, and create strategies that are really, combine the kinds of companies and, market cycles, economies, countries, in very creative ways to create a really not only differentiated strategy, but also a strategy that creates alpha or generates alpha in an uncorrelated way with other investments that clients or investors typically have. So it's those that combination of characteristics that led us to specialize in the small and mid cap equity space, and we've built all these strategies and I think an investment management firm that really specializes in the small and mid cap segment globally.
Yeah, what I love about that is the idea of sticking to your expertise. I think a lot of times people try to do it all. I think being really good in a specific segment or strategy is a great value add. So about a year ago, you launched your first ETF. AZTD is the ticker. So let's talk a little bit about that effort. Why did the ETF wrapper appeal to you? How did it fit into your business strategy, and how it helped to deliver your value proposition?
Yeah, great. That's a great part of our story or history, even to explore in a little bit more detail, because I think that allows us to communicate one of our key attributes as a firm, is that we'd like to think we're problem solvers, and we bring creative solutions to problems that our client investors bring to us. So AZTD is all of that because it was created out of a necessity or out of a requirement from one of our institutional clients in Mexico. So we were managing at that point the stock picking small and mid cap strategy globally. We had a private fund, and we also managed the strategy through SMAs. And so for this particular client, we were implementing the strategy through a like a model kind of arrangement, right? We provide the strategy, and then they implement. It's a large advisor, so they have many accounts within that firm, and so they were implementing that same strategy across 50 or 100 accounts, okay, in Mexico. So we want to implement a strategy that invests in wonderful companies, stock picks in Japan, in the Nordics, in Canada, in the US, France, Germany, etc., all the developed markets, Australia, by bringing those names to the local market through a specific process that you have to do to bring those names to the local exchange in Mexico, and then implement in the local accounts. And so there's a lot of inefficiencies, as you can imagine. From the timing, it just takes time from the time you identify the opportunity to the time it's available for investment, to all the inefficiencies in terms of trading and currencies and just managing numerous accounts. So so the client said, okay, can we implement this strategy, but through a wrapper that is efficient and that we can implement across all these names. And by the way, if you implement and invest through the local market, you get there's a tax incentive, there's a tax benefit,
right,
for doing it locally rather than buying abroad. So okay, so we went to the drawing board. Okay, how can we do this? We did all our research. And one of the things that we found out was, okay, the ETF wrapper is really, specially designed for this kind of solution. But then we have another impediment to bring an ETF to Mexico. What's that impediment? In Mexico, you cannot have actively managed ETFs. ETFs, in order to list them in Mexico and have that tax benefit or tax incentive or treatment, rather, you have to be indexed. It has to be passive. Okay, so how do we create, or how can we replicate what we do on the stock picking active side with an indexed strategy? And so we again went to the drawing board and said, okay, yeah, we could possibly do this. Let's the quant part of our process, we already have a quantitative model, and it's fundamentally driven, right? So the variables that we evaluate in our quant model: free cash flow, valuations, return on equity, earnings growth, that kind of thing. So we created all these rules that would be eventually part of that index. And then, once we have the index, we launched our first index. Actually, we're going to be 2 years next month, November of 2021. Is when we finally launched and published our first index. This was done with Solactive, which is one of the large index providers. So all the development of that index with all the rules was designed to replicate the stock picking process that we had in place at that point for some years, but that we could create the index and then launch an ETF that would replicate the index that would then be brought to Mexico. So we created the index in that way.
Yeah, no, what's fascinating about that is that when you think about a small cap or even a mid-cap approach that is global, and you're talking, for example, a lot of emerging markets, you immediately think the opportunity would be in active management for differentiation. And you guys are a global firm. You have people we were talking before the call, like Hong Kong and Mexico and Argentina, the US. So you have the boots on the ground. So everything about the story suggests this is going to be an actively managed strategy. And it's fascinating that you are, constrained to the passive wrapper. Do you find the index approach has enough flexibility or elasticity for you to be as hands-on as you would have been outside of that ETF wrapper in your separately managed accounts? Does it fit for purpose really well? How does that, adaptation been?
It's that's the right word. It's an adaptation, and it's always a learning process. I think, or at least it feels like the learning curve never ends. We're always on that learning path. And in terms of the passive strategy, the way we think about it, it's really it's an active strategy with a passive framework, or the other way around. So in other words, we have rules that are published on the index. The ETF follows those rules, and that stock composition. But in the end, if you look at the index and the ETF, it's a stock selection ETF. It's there's nothing quite like it out there. You do have small mid-cap, broad exposure kind of ETFs and strategies out there that will give you, it's like the Russell 2000, right? You have exposure to 2,000 securities. So it gives you the other competing strategies are giving you exposure to the segment or to the theme. In our case, the way it's designed, we have the best stocks globally picked from Japan, from the Nordics, from the mainland Europe, from the US and Canada, based on these rules. And the rules are quite simple. It's cash flow generation, it's valuations, it's return equity, and it's earnings growth. And so based on those fundamentals that I think, we all agree that, that's, those are desirable attributes for any investor to have in a company that he or she owns, we're just, applying that for the stock picking process in a rules-based environment to create this highly concentrated strategy. the top 27 names across developed markets, which is an investable universe of roughly 4,000 securities.
It's yeah, and I love that idea. I noticed that when I was looking through your website earlier, some of the key concepts, the concept of concentrated but diverse.
Yes.
And that is a key point of the strategy. So, what does that balance look like? I think it's an interesting exercise in not getting too much single stock risk, just getting just enough. What have you found that makes a difference in that?
Yeah, one of the problems that we had to tackle when we were creating the index for the eventual ETF was how do we, well, first of all, how do we select those, the top names in the world? So that was kind of easy, right? We just apply the rules, and it's like applying a screen, pick the best names that have highest cash flow, return equity growth, etc. That's the lowest valuations. But then how do you, once you pick those 27 names, or 30 or 40 or 50, how many names do you want to pick? And then how do you mix them together, and how do you make the weights or the allocations? And so after many iterations back then, I remember maybe 3 years ago, 2.5 years ago, we went through all these different iterations and analysis, and we were like really thinking hard about it. And what I love about the final product and the outcome is we came up with the simplest solution, which was, let's just go equal weight. We go equal weight. We're picking these three regions: North America, Western Europe, developed Asia. We have 9 sectors. By the way, we excluded, high volatility sectors like energy and biopharma and biotech. So those are excluded. We're left with 9 sectors. So we ended up with a matrix: 9 sectors, 3 regions. So that's 27 stocks to pick. So let's pick the number 1 in each of those region sectors, and it's just going to be equal weight. So we're going to have a third in each region, 1/9 or 11% in each sector, and 3.7% for each stock. And that will give us the concentration, because it's 27 out of 4,000. It's really, a really interesting sample of companies that have very strong fundamentals with this very systematic and very simple diversification. You're exposed to the 3 regions, to the 9 sectors in an equal weight environment.
Elegantly simple. There's a beauty to that.
Yes, absolutely.
That's cool. So tell me a little bit about your experience as an ETF provider. I know that's a completely different ball of wax than it is just to be an advisor. What's been the toughest part or the most rewarding part of being in this industry?
I think they're both, very rewarding aspects to it, very tough parts to it as well. I think there's a funny quote that says, "We did this not because we thought it would." How does it say? Because we thought it would be hard. We did it because we thought it would be easy. So it's like you're always not aware of all the difficulties that lay ahead. So the rewarding part is after we have gone through the process, we're now, we created our second index. We just published this index last month. It's a thematic strategy. There'll be a strategy obviously coming soon. But some of the rewarding things about this is, as we learn, we understand that there's a lot of value in this wrapper, this way of bringing a strategy to the market, and so that allows us to bring other strategies that we know are of interest and would be in high demand from both our current client investors and other, just the broad market in general. So it's great to learn how to effectively use these tools for the benefit of our investors and the market in general. The other rewarding part is we're now it's the word is getting out there, and all these things have been innovations in a very clear sense, at least for the Mexican market, because of these restrictions. So we found a way to to bring products to the market with this passive structure, but keeping those active characteristics that we described. So those would be the rewarding parts. The challenging parts are, I think as an entrepreneur, you're always very optimistic, and you always think that things will be easier, faster, cheaper, and it's almost 100% of the time the opposite. It always takes more time, it's more, and it's super difficult. We were really struggling at first during the first 3 months of the original launch, which, by the way, was a little over a year ago. We were now the anniversary was this last August. So we're struggling with a fund that was not, if you're below 20 or 30 million dollars, you're not viable long term. There's it's costing you quite a bit. So we were there, but we worked really hard in terms of marketing and convincing investors to invest, and we were also lucky, and so that's usually a good combination. Hard work, and so we were able to ramp up to $50 million, almost $60 million. It fluctuates now with the recent downturn this last month, or drawdown. It's come down, but we're in a good. It's a small fund, but it's viable and good size.
Yeah, and quite frankly, it's a success story. I mean, in just about a year, you're hitting $50 million, which is a success story for a newcomer to the space. Lots to be proud here. I love that. I think the theme of this episode of Wavemakers is a little bit of crazy and a little bit of ignorance is what it takes in the advisory space and in the ETF space. But I love that. Listen, as we wrap up, since you're a CIO, you have a very specific focus. I thought it'd be like a cool opportunity to, just go there a little bit on, last quarter here, maybe immediate opportunities you're seeing in the market. Equity markets are very nervous lately. So any pearls of wisdom for those of us trying to figure out what to do by year end, if anything?
Thanks, Cinthia. Yeah, well, so as you mentioned, we're a boutique small firm, but we're also international. So we have presence in Argentina, and Hong Kong, and the US, and in Mexico. So we have boots on the ground, and we're close to the companies and close to the markets where we invest in. And we have our investment committee. We get together every Tuesday morning, between 1 and 2 hours. By the way, all our investment committee meetings are recorded, so we have more than 5 years of recordings there as part of our databases. And we're definitely seeing a challenging environment, globally speaking, both developed and emerging markets. We're definitely entering a new market cycle with this very swift and significant increase in interest rates globally. I think ultimately that's healthy for the global economy. We need real interest rates to be part of reality back again. I think the anomaly was really the last 10 years where we had the negative real interest rates. So having real interest rates poses a challenge to investments, especially in the equity space, because now you have a real competitor, right? So if you compare the 10-year treasury yields to the S&P 500 average earnings yield over the last 10 years, we had a very significant advantage. So equities were clearly cheaper, just in general. You just pick blindly any stock, and it would more likely than not be cheaper, or cheaper, and generate more earnings per unit of dollar than fixed income. Now we're back again to normal, and so I think this environment is especially favorable for managers like ourselves that are quantitative plus fundamental, do the research, and do the stock picks. It's a matter of finding those very unique companies that have great business models, that generate cash flows, that grow those cash flows over time. That I think it's a wonderful environment for that kind of investment process. It will be challenging. I think we will continue to see volatility. It will likely be one of the longest, not the longest recoveries in recent history. I mean, we're already into the second year of the recovery. Remember, the high water mark is fourth quarter of 2021.
Mhm.
So it's almost 2 years, and we're still quite some percentage points away from making that high water mark again. And markets are nervous. I think the key narrative, as we all know, is interest rates and in response to inflation. The good news there is we see inflation coming down. Also, the monetary policy response has been very aggressive, the steepest increase that we've seen in recent history, perhaps one of the steepest increases of all time. And so we're at the later stages of that whole process. But as things normalize and all market participants rearrange and in some cases retool their processes and market views, we'll see a lot of volatility, a lot of nervousness from market participants. And I think what's important to keep in mind is, as investors, no matter how you approach investments, you have to have a process, a systematic process in place, and you have to keep your eyes on earnings. That's ultimately what matters. If the companies are generating earnings, then everything will be okay.
Well said. Well said. Well, Alejandro, thank you so much for coming on the show. Congratulations on the anniversary of the first ETF and on the success of the firm. And I want to thank everybody for joining us in Wavemakers, and we'll see you all next time.